A financial reset is taking place. Digital money is here. This is what you need to know. Most people think the money in their bank account is already digital, but what governments are building right now is something completely different. It's called a CBDC, a central bank digital currency, and it could change how you spend, save, and control your own money. This isn't theory. Countries around the world are actively developing this system right now, and whether you realize it or not, this will affect your everyday life. In this video, we are going to break down exactly what a CBDC is, why governments are pushing it now, and what it means for you. This is part one of a three-part series where we go from understanding the system to understanding the why, to how you can position yourself for the world being built right now. Welcome back to Bitcoin, Crypto, Gold, where we focus on the biggest wealth opportunities across Bitcoin, crypto, and gold, using macro, technicals, and strategy. If you want that in a simple daily format, the free newsletter is linked below. It's a quick 5-minute read. Let's get into it. Fiat is being phased out, and here is why. Let's start with a simple truth that most financial media dances around. The era of physical cash is ending, not because governments suddenly decided they wanted digital money, but because decades of printing money, more and more of it, have quietly destroyed the trust that makes paper currency work. The first thing to understand is this: if two people exchange cash, there is no record a transaction took place. Zero. No bank, no government, no trace. Here's what we mean. When a government prints more money, every note already in circulation buys a little less. Your salary stays the same on paper, but buys less food, less rent, less of everything. This is inflation, and it is not an accident. It is the mechanism governments use to manage the debt they have accumulated. They inflate it away, slowly, quietly, year after year. But the shift away from cash was not just driven by governments. We drove it ourselves. COVID, the moment everything accelerated. Before 2020, the decline of cash was gradual. Contactless payments were growing. Mobile wallets were becoming normal, but cash was still widely used and most people did not give it much thought. Then, COVID arrived. Overnight, physical money became something people did not want to touch. Shops put up signs asking for contactless payment. Banks reduced cash handling. ATM usage fell dramatically. In a matter of months, millions of people who had never thought twice about using cash found themselves using it rarely or not at all. At the same time, governments faced an urgent practical problem. They needed to send money, large amounts of money, quickly, directly to hundreds of millions of citizens. Stimulus payments, support grants, emergency funds. The traditional banking infrastructure was slow, expensive, and patchy. Millions of people did not have bank accounts. The commercial banking infrastructure was simply not built for what governments needed. The idea of a direct digital channel from the central bank to citizens, money that could be issued and distributed instantly without going through commercial banks, went from an academic concept to an urgent policy priority almost overnight. COVID did not create the CBDC, but it demonstrated in real time exactly why governments wanted one, and it compressed what might have been a 20-year transition into 5. The move to digital money is now irreversible. The only question is what form it takes and who controls it. So, what exactly is a CBDC? A CBDC is the money you use, but in digital format, and at first glance, that's no different than when you swipe your card for a coffee or a meal. But here's the difference. In this financial reset, we are seeing a split. A CBDC is money issued by the government, we'll go into why in a minute, and stablecoins are the main vehicle your physical note is transforming into. Let us explain both, starting with CBDCs, as they're the simpler concept. A CBDC is digital money issued directly by a country's central bank, the Bank of England, the Federal Reserve, the European Central Bank, the People's Bank of China. It sits in a digital wallet on your phone. Your salary can be paid in CBDC, and the government can automatically collect its taxes before you've even spent 1 cent. CBDCs are designed with a focus on regulatory control, anti-money laundering compliance, and the preservation of national monetary policy. The network is maintained by a select group of authorized validators, usually commercial banks or government entities. This controlled approach allows central banks to retain strict oversight on who can access the network and how data is shared. You pay by tapping, scanning a QR code, or using NFC technology, just like contactless payments today. It feels familiar. That's part of the design. As of early 2026, over 130 countries, representing more than 98% of global economic output, are at some stage of CBDC development or deployment. China is furthest ahead. Its digital yuan, the ECNY, is already being used by hundreds of millions of people. The European Central Bank is building the digital euro. The UK has been researching its own version. The US is moving more slowly due to political debate, but the work continues. This isn't a future scenario, it's already happening. So why are governments doing this? Let's look at the benefits, because there are genuine ones. The benefits of CBDC. Let's be fair, there are genuine and significant benefits to CBDCs, and understanding them matters as much as understanding the concerns. Increased efficiency and lower costs. Today, a simple bank transfer between countries can take days and cost significant fees because it passes through multiple correspondent banks, each taking a cut. A CBDC can settle the same transaction in seconds at a fraction of the cost. For businesses, for individuals, for governments, the efficiency gains to CBDC is real. Financial inclusion. Around 1.4 billion people in the world do not have a bank account, but many of them have a mobile phone. A CBDC can give someone in rural Nigeria or rural Indonesia access to a digital wallet and a functioning payment system without needing a bank account at all. Around a third of people in Nigeria currently have no access to traditional banking. A CBDC changes that. This is one of the genuinely compelling arguments for CBDCs, bringing people into the financial system who have been excluded from it. Safety and financial stability. Because a CBDC is a direct liability of the central bank, not a commercial bank, it carries no bank failure risk. Your commercial bank can go under. The central bank cannot fail in the same way. From a pure payment safety perspective, a CBDC is more secure than a commercial bank deposit. Programmable money and smart contracts. A CBDC can use smart contract technology, automated, conditional payments. A government can program a stimulus payment to be sent automatically when certain conditions are met. An energy company can set up automatic smart payments triggered by usage. A business can automate payroll and supply chain payments. The efficiency gains from programmable money, properly designed, are significant. Reduced cash management costs. Printing money, transporting it, securing it, replacing damaged notes, all of this costs governments enormous amounts each year. Digital currency eliminates most of that cost. Improved monetary policy. CBDCs give central banks a more direct and precise tool for implementing monetary policy, getting money to where it needs to be faster with less leakage through the banking system. These are real benefits, and they explain why so many countries, including those with very different political systems, are moving in the same direction. But CBDCs also raise serious and legitimate concerns, and these deserve equal weight. Privacy. Every CBDC transaction is recorded on a system controlled by the central bank. Every payment you make, every person you pay, every purchase you complete, permanently logged. Cash does not do this. The financial privacy that people have always taken for granted with physical money disappears with a CBDC. How that data is stored, who can access it, and under what conditions are questions that most CBDC designs have not fully answered. Programmable money as a control tool. The same feature that makes CBDCs efficient, programmability, also gives governments tools they've never had before. Expiry dates on money, spending restrictions, geographic controls, automatic negative interest rates. These aren't theoretical. China has already tested expiry dates on digital yuan payments. The European Central Bank has discussed programmable spending limits. The power to program money is also the power to control how people spend it. Cybersecurity risk. A CBDC centralizes the entire monetary system on digital infrastructure. That creates a single point of failure. A major cyber attack, a technical failure, or a targeted hack on a central CBDC system could potentially disrupt the entire economy's payment infrastructure simultaneously. The more centralized the system, the more catastrophic a successful attack becomes. Disintermediation of commercial banks. If people hold money directly with the central bank in CBDC wallets, they may move deposits out of commercial banks. Commercial banks fund lending, mortgages, business loans, consumer credit from those deposits. If deposits move to CBDCs at scale, banks have less to lend, credit tightens, and the broader economy feels the impact. Central banks are aware of this risk and designing limits, but the tension is real. These concerns do not mean CBDCs are bad. They mean the design of CBDCs, who controls the data, what can be programmed, how limits are set, matters enormously. And those design decisions are being made right now, largely out of public view. Now let's talk about stablecoins. So that is CBDCs, government-issued digital money with real benefits and real concerns. But there is a second form of digital money that is already widely used and growing fast, and it is fundamentally different. A stablecoin is issued by a private company. Tether issues USDT, Circle issues USDC, PayPal issues its own stablecoin. These are privately run businesses, and their motive is commercial: profit from transaction fees, interest on the dollar reserves backing the coins, and the enormous opportunity of providing fast, cheap, accessible digital payments to anyone with a smartphone. The use case is compelling. Faster cross-border payments. The current international payment system, built on SWIFT and correspondent banking networks, is slow, expensive, and opaque. Stablecoins can bypass much of that infrastructure, making cross-border transactions faster, cheaper, and more transparent. For families sending remittances home across borders, the savings are meaningful. Global financial access. Stablecoins, such as Tether, USDT, or USDC, are accessible to anyone with an internet connection, providing a stable alternative for individuals in developing countries with high inflation or poor banking infrastructure. Reduced volatility. As they are pegged to stable assets, usually fiat money or treasuries, they provide a reliable, low-volatility medium of exchange and store of value compared to other cryptocurrencies like Bitcoin or Ethereum. DeFi and crypto trading liquidity. They serve as the primary on-chain liquidity tool, allowing traders to quickly move between crypto positions without converting back to fiat, and act as essential collateral in DeFi lending and borrowing protocols. Programmability. Stablecoins can be automated through smart contracts to allow for instantaneous payments, automated escrow, and new financial applications. Transparency and security. Transactions on public blockchains are transparent, providing a secure, audit-friendly, and verifiable record for businesses and auditors, reducing fraud and reconciliation issues. Stablecoins are already being used for trading on crypto exchanges and increasingly for everyday commerce, particularly in countries where the local currency is unstable. They are fast, they are cheap, they are accessible to anyone with a phone, and they have provided financial access to millions excluded from traditional banking. But stablecoins carry their own risks. A private company can freeze your account. It can comply with government sanctions and block your access. It can fail if the reserves backing it are mismanaged, as we saw with the collapse of Terra USD. The company is a counterparty, and counterparties can fail or be forced to act against your interests. So why do we need both CBDCs and stablecoins? They actually serve different purposes, and that is why both are being built simultaneously. CBDCs bring sovereign trust and stability. As a direct liability of a central bank, a CBDC is effectively digital cash, the safest form of digital money, built for financial stability, policy enforcement, and regulatory control. Anti-money laundering, know your customer, monetary policy transmission. This is the government's tool. Stablecoins bring innovation and speed. Issued by private companies and operating on open blockchains like Ethereum or Solana, stablecoins offer superior speed for cross-border payments, 24/7 availability, and instant programmability. They are essential for decentralized finance and global commerce. This is the market's tool. Together, they form the new financial architecture. Digital money at every level, from central bank to institution to consumer, being built right now, whether or not most people are paying attention. That is part one. The era of physical cash is ending, driven by decades of inflation, accelerated by COVID, and now embraced at the highest institutional levels. CBDCs are the government's version of digital money, sovereign, controlled, with genuine benefits and genuine concerns. Stablecoins are the private sector's version, commercially driven, faster to deploy, widely used but with their own counterparty risks. And underneath both, new financial rails are being built that most consumers will never see, but everyone will use. In part two, we ask the question that connects all of this to the bigger picture. If governments are building the most sophisticated digital monetary system in history, why are those same governments buying gold at the fastest pace in decades? The answer takes us to the petrodollar, the fracturing of SWIFT, the rise of BRICS, and the geopolitical reset that is reshaping the global financial order right now. Before you go, join our free daily newsletter for Bitcoin, crypto, and gold investors. The newsletter covers everything you need to know to make rational, balanced investment decisions. It's usually a 5-minute read. The link is above and in the description. Subscribe to Bitcoin, crypto, gold, and hit the notification bell so you don't miss part two. Thank you for watching. We'll see you in the next video.